Good afternoon and great to be with you. Thanks for allowing us to present. So I'm the CFO of MoneyMe and pleased to present to you today. If we can go to the first page, just a little bit of an overview of the business. This is a business, is an Australian mass market consumer finance lender. It's got a blockbuster product range that really services consumer finance across the life cycle. So there's an auto finance product, there's a personal loan product, there's a credit card product out there sort of looking after the digital consumer, very much driven by an experience powered by technology. So its own technology stack, which allows the business to provide close to real-time decisioning when in the loan decisioning process. And it's very much a business for generation for today, who expect the highest levels of sustainability, but also a digital way to interact as they go about their daily lives. If we go on to the next slide, I'll talk a little bit more about the opportunity that the business has. The business has been around for about 10 years. It's made significant success in building in those three core product areas that I mentioned before: personal loans, credit cards, and auto. But despite that success, it still only represents about 2% market share across those sectors. And so the opportunity for growth is absolutely massive. And what we're finding is the competitors that we're up against, the traditional providers of finance, are really sort of held back by often legacy technology. They've often got very slow, clunky processes, and their innovations clearly often not there. We're also finding in some of the markets, particularly the auto market, where the major banks are removing themselves from the market and are otherwise focused on mortgage and business lending. So it really does present a huge opportunity for the business to look into. Over to the next slide, you can talk about how we're winning that market share is really on customer experience. And the scores you can see there on the right of the screen really sort of say more than anything. The business has been posting these high NPS scores of well above 50 for years and years and years, compared to the major banks, which are at 0 or close to 0. And that's because we've got this technology stack that helps solve those traditional lender pain points. A product in auto finance, for example, where it can be introducing a lend within an hour, whereas maybe some of the incumbents, we're talking days, if not weeks. So it really is a revolutionary experience for the customer, and that's why those NPS scores are exactly what they are. If you move on to the next slide, there's a little bit of a history for where the business has been from over the last 10 years. So 10 years young, started off with a personal loan product in 2013, built its first sort of setup of what we call the Horizon technology platform in 2016. That's a fully in-house built platform, fully owned sort of by the business and on a modular basis. And that's allowed then the business to expand further over time without the legacy that other incumbents have got. This first funding warehouse was launched in 2017, which has since significantly expanded to 8 different structures. A credit card launched in 2018, listed in 2019, and then the car finance, which has been particularly successful only quite recently in 2021. The Business Sport Society one last year, and then and this year in particular, it's really showing the scale returns from all that growth in the prior years, and also from the integration of the Society One business. So a really busy, successful sort of path there over the last 10 years. If you go to the next slide, we can talk a little bit about then what that looks like in terms of the numbers and more recently. What we're seeing at the moment is the scale automation benefits from the business driving the strong returns. So we've got gross customer receivables from 2021 growing from $0.3 billion to $1.1 billion in 2023. Revenue going from $58 million in 21 to greater than $230 million in 2023, and operating office cost income ratios reducing from 46% to less than 25%. So really impressive numbers on the back of that scale and the automation that the business has delivered. At the same time as delivering that growth, delivering those scale benefits, the credit risk of the business has reduced. And so the average Equifax score of the book now is 83%. is much in that sort of 700 plus range, whereas it was only sort of down to about 63% only a couple of years ago. That will continue to improve as we further transition to a higher credit quality consumer. It's also being supported by a higher amount of secured assets that the business is having on its books now, sort of 43% at the end of 2023 and just 2% a couple of years sort of prior to that. In line with that, the net losses of the business are improving quarter on quarter. There's an improvement and expectation they'll continue. And what's happening there is we're seeing the lower credit quality book is rolling off, and then we're seeing it being replaced with these higher credit quality assets. So an impressive set of numbers, particularly over the last sort of 2 or 3 years. If I then go to the next slide, we can talk a little bit about the context and sort of where the business is looking to go. The business achieved profitability, statutory profitability, not cash profits, but statutory profits in 2017. It also had stat profits in 18, 19, and in 20. And that was while it was steadily growing its book up to about $134 million by the end of 2020. Had a period of high growth from 2021 and 2022. That's when the business really got the loan assets up to the scale now above $1 billion, so 1.3 billion by the end of 2022. And as a result, there were some statutory losses in those years, as expected, with the recognition of upfront costs. In the last year, we've announced our half-year result a little while ago now. We look forward to announcing our full-year result by the end of August. The business moderated its growth strategy and posted a $9 million statutory profit for the half. So really impressive to see how it's turned that around. You can see the scale benefits flowing through the P&L. Looking into FY24 and beyond, the key focus areas are still continue to look to make sure we've got the best technology and innovation. That's what's underpinning the growth and the value of the offering to the customer, and then driving the underlying value. We want to continue driving that credit quality up, particularly through secured assets, and with the AutoPay product, we know we've got a gangbuster product that we can win within the market. We still expect to get significant operating leverage using the technology, because so much is digital, so much is straight through, and seeing those advantages go through to the consumer, but also to the bottom line, so we can get those financial returns robustly over time. At the moment, we're still in the immediate term sort of having modest originations, but we're basically looking to be ready for when the market conditions allow. So if I just go to the last slide, to summarize up, really the business here has got a superior customer value proposition, very much underpinned by its tech stack and the innovation that it's been able to provide in the products. Huge scale opportunity in the silos that it's chosen to compete in, and then the attractive return opportunity that it's got ahead of it, particularly, we think, at a particularly low share price. Over to you. Thank you, Paul.
I would agree. I'll come back to that in a second. I've got a number of questions for you. What is your credit risk like in the current environment? You touched on it. Maybe just go into a bit more detail.
Yeah, no, it's definitely the right question to ask, because when you're in an environment like we have, sort of, I think interest rates going up 400 bips in a very short period of time, inflation concerns and credit environments, there's an understandable concern. We've seen that, and I think we've probably calibrated maybe quicker than most. So you'll see that our Equifax score has increased massively over time. So now to above 700, we're going to see that continue over. So we think we're very well positioned for the current environment. We're not looking to change our settings anytime soon. So we're calibrated for it. A key one for us, Paul, is that the AutoPay product, because it's got access to that secured asset, which of course sort of makes it so much more robust. And it's lovely to also have that diversification across the products that we have as well, and also across the country. We're just very, very sort of careful to make sure we've got that diversification protecting us.
And you mentioned, your half-year results were extremely strong. What's the market missing? Because it's not being translated into your share price.
You're right. It hasn't been reflected there. And look, it's a frustrating sector to be in. I guess this is the same. This is happening across the whole non-bank sector. We can see it coming down, and people are concerned, I think, about inflation, right? So credit risk, as you just mentioned. We also had a particular situation where we needed to pay back some corporate debt that we took on as part of our Society One acquisition, and there were concerns with people around us being able to do that. We've done that. We had a very successful equity raise just recently. That's now behind us. We are looking forward to posting the results sort of shortly, and in the fullness of time, I will let the numbers do the talking, and I'm sure the share price will do what it should do.
Yeah, that's the spirit. Let the numbers do the talking. With the auto pay becoming one of MoneyMe's core products so quickly after launch, what is your future in car finance?
Oh, I think it's got a potential to be huge. And really, that's because the technology is so good. And we know that the offering we've got, we think we're quite a year or so, maybe 2 years, maybe more ahead of a lot of the incumbents. If you go into a car dealership on a Saturday or a Sunday, you might see a car, you want to buy it that day. Often, if you haven't got an auto pay offering, you can't do it. You might settle it next week, it might be the week after. We can literally do it within, I think the quickest the guys have done it, was in about sort of 35, 40 minutes. It's incredible. And that's not about cutting corners. That's about just doing things smart, innovative, digital, no paper, straight through, just get it done in a really modern way. So people love that experience. And it's not just the retail consumer that loves that, it's the broker, it's the dealer, because everyone gets the value that they want from the process there. So we know when we have the opportunity to open up the doors more, the opportunity, it really is exciting.
My wife is an impulse buyer because she can be very dangerous when she goes into the car showroom.
There we are. Make sure when you go to the showroom, you haven't got to auto pay then.
And this one, I've got to ask this question. Why is MoneyMe profitable and your peers are not yet making a profit?
Oh, it's a good question. Look, I can't comment about other, and I shouldn't comment about other providers. We love to see others win in the market. In terms of how we've sort of managed our business, we think we've run it in the right way in terms of for the returns. It is quite impressive. You can see in the last year, we've just been able to pivot so quickly to be able to get back to that profitability. And it's really because the underlying economics is just managed in the right way. Particular challenges over the last year or so with interest rates rising, we've got a predominantly variable rate book, and we've been passing the cost of funds onto the consumer in a way that, as we should do, to protect margins by still doing the right thing by the consumer. I think that the key underpinning for the business here is that tech stack and that ability to keep those costs down. And if you've got that digital straight through processing sort of side of things, and you've got some sort of scale as well, then that really does give you a head start across so many wells. So we'll continue focusing on that. Profits are important, particularly in this sort of environment. Returns are important to be able to make the show that through to the market.
Yeah. So in your most recent trading update, you reported some strong returns. To what extent has scale and automation driven these results?
Oh, it's been huge. So you saw that office operating cost leverage coming down from a 40 plus number, coming down to less than 25%. It's huge. And there's so much more to come, Paul, as we get further scale benefits coming through, as we invest further in the tech stack to make things even more straight through and innovative. So, and what's lovely about, as you invest in the tech stack and we continue, and that's the benefit of having our own tech, we're not relying on anybody else. It's all fully ours. We understand it. We know it. We keep investing with it over time relentlessly. And what we're finding is then we get the benefits of the consumer and the customer getting the extra sort of innovation that they demand and they want, but also we get those scale benefits because so much just goes through without touching a single person. So you can increase your flow through, and there's no actual sort of cost increase as well. So you've seen those benefits coming through. That's pretty impressive to come down from that over 40% down to 25 in a couple of years. You should expect to see more of those benefits coming through as the business scales.
Fantastic. And how much further can the transition to higher quality assets improve performance?
We'll continue to go up. I think you're right. It gets to a point where, and we're not looking to get to some 900, 1,000 Equifax. That's not it. We're looking to have a broad shop, and that's what we've got. We're just very much conscious of the current environment that we're in. There's a lot of uncertainty. So this isn't the time to be loosening credit. If anything, it's the time to basically be keeping it pretty tight. And that's exactly what we're doing. We're keeping it really tight. We're focusing on the secured asset market because that's the right market to go into. But we're a mass market consumer across Australia. We want to service all consumers. We have products that offer for everybody. And we want to keep that broad shop, that shop as like that broad shop front.
Look, the strategy is clearly working. And one to finish up here, how does the pipeline for opportunities look going forward?
It's significant. So we've chosen those three silos, both personal loans, credit cards, auto pay. As I say, we're less than 2% of the market. The opportunity as we open up the originations, and very much at the moment we're holding back on purpose to moderate and support the growth and understand the risk environment. The opportunities are just huge. What's really pleasing as well, just in the last year or so, not only have we got that diversification of products, but the distribution channels that we've got have really expanded. So when the business started, it did the hard yards, got really good at direct-to-consumer distribution. That's all the distribution was all direct-to-consumer. Now we've got a mix of direct-to-consumer with brokers, with dealers. It's quite formidable in terms of how can that could deliver. So if we open up the pipeline, we know with the product we've got, it's got a long way to run.
Neal, it's been an absolute pleasure. Fascinating story. Eagerly be waiting those results at the end of the month, and we'd love to get you back on later on in the year.
Sounds good. Look forward to it.